we're starting off with the terminology. As you know, these are extremely important, and the first one we're going to look at, obviously dealing with foreign exchange markets, we're looking at Forex, so we're obviously going to start off with the exchange rate. Now, very quickly, you should by now know what this is. I just need you to think about it for a moment and then see whether you were correct. The rate at which one country's currency is exchanged for that of another country. Balance of payments. This is something new that you've just been introduced to in Matric. But here, I don't want to know what the accounts are or any of that. We just want you to give a definition for or a description of what balance of payments actually is. And if you recall, balance of payments deals with imports and exports. So that should give you a clue as to what the definition or the description would be. And that is the difference between the money entering and exiting the country over a defined period of time. So this is the balance of payments takes into account all the monies coming in and all the money going out over the defined period of time. Then, as part of your balance of payments, we have what we call the current account. And as the name gives you a clue, it says current. So if you think of what the term current means what's currently happening, what's happening right now. Like currently we are now doing foreign exchange markets, right? So when you talk about a current account, this refers to the account in which we will record all the day-to-day transactions regarding our imports and our exports, right? So the current account measures the inflow and outflow of goods, services, investment incomes, and transfer payments. This is the one concept that confuses a lot of learners in the current account. A transfer payment is any payment or anything that you receive money for which you have not worked, or when you are paying money to somebody who hasn't done something in return for that. For example, old age pensions is an example of a transfer payment. A donation would be a transfer payment. If your aunt from America sends you some dollars for your birthday, that would be part of transfer payments. If you paying for stuff that for outside the country, when you're sending money to somebody outside of the country, that would be a transfer payment as well. But we're still looking at what is happening with your balance of payments. You also have your capital transfer account. So this deals with all the capital expenditure and income in the form of investments and loans that are flowing in and out of an economy. And then the last account that makes up your balance of payments is the financial account, right? So that name says it all, financial account. This one shows the net acquisition and disposal of financial assets and liabilities. And just to point out, this is seen as the accounting section of economics, but as in accounting, we normally subtract liabilities, but here we add liabilities and we subtract assets. The reason being, when I'm buying an asset, I am spending money to get that asset. So therefore, the assets on the financial account is logged as a negative, whereas your liabilities will be positive, because when I make a loan, I am receiving that money, right? So therefore, liabilities are added, assets are subtracted. Then we have the terms of trade, which followed the balance of payments, and then your terms of trade, that obviously deals with the relationship between a country's expense from its imports and its profits from exports. Then we come to international trade. So as you should know, when we refer to international trade, happens in open economies, right? Because remember, in an open economy, you have the foreign sector, and this is most countries around the globe. We operate where we trade with other countries. So various currencies are used as mediums of exchange for this reason. And just on that point, I don't know if you guys have been listening to the news, but there is a move from the BRICS Bank for the de-dollarization, meaning they don't want to be doing business in dollars anymore. They are thinking of bringing out their own currency. Right, so your mediums of exchange are governed by various exchange rate systems, a very possible 8 marker where you can be asked to discuss these systems, right? The first one is your free floating exchange rate system. Now, as the name depicts, it is free floating. So this is the exchange rate system which South Africa is currently following, and therefore you will see our rand is up and down all the time because the Reserve Bank does not get involved in the setting of our currency. It is up to demand and supply. That is what happens when you follow a free floating exchange system. That is where you rely on demand and supply to set the value of the currency. The next one is what we call a fixed exchange rate system, and this is when one country will adopt another country's currency and peg their local currency to that foreign currency. This is something that works very well in the short run, but it's not advisable for countries to follow this sort of system, so it's not widely used any longer. And then we have the managed floats or controlled floats, and this is the system South Africa used to follow in the past. We had the managed floating exchange rate system. This is when your reserve, in South Africa we refer to it as a reserve bank. In other countries they talk about the central bank. This is where they will get involved in managing the value of their currency. And the way in which they do that is by, if they see their currency is weakening, they will flood the market with foreign currency. Because remember, we spoke about demand and supply. So if you flood the market with another currency, you're increasing the supply of that currency. And obviously, when there's an oversupply of something, then that drops the price. And the way in which they do that is when they're paying debts to other countries and that they would use another currency instead of their own. And in that way, they flood the market. Right, so just to recap quickly here, your free floating exchange rate is where we depend on demand and supply to determine the value. A fixed exchange rate system, in economics, we talk about you peg your currency to that of another country, and then the managed is where your central bank or your reserve bank gets involved in setting the value of the currency. Now, why does international trade exist? And this is one of the possible essays for paper 1, and this is the possible essay from this chapter, the reasons for international trade, and we are looking at the demand reasons, and later on we will be looking at the supply reasons. So with the demand reasons, the first one we're going to look at is the size of the population. So obviously, as the population growth increases, demand is going to increase. And remember, the size of the population can increase either through an increase in birth rates or people coming from outside to settle in our country, right? So obviously with more people in the country, there is a bigger demand and more needs that needs to be satisfied. And obviously if the country doesn't have enough to satisfy the needs of their people, they would then have to buy it from outside. The second demand reason is income levels, right? As people's income changes, so too do their demand for goods and services. So the more income people have at their disposal, the more goods and services they will demand. So obviously, if the country once again cannot supply all that is needed, they will then have to look at getting that from outside. Change in the wealth of the population, right? As people become wealthier, there is a greater demand for goods. And obviously here now, the demand is for more luxury goods. Because as the wealth of the population changes, they have greater access to credit, so they can afford to now buy these luxury items. And many a times, the technological like we're living in a technological age, and we don't have those things locally, so it has to be brought in from outside. And therefore, with this situation, we find that your developed countries benefit way more than the developing countries. Because obviously it is those developed countries that have the resources to supply those products. Right, preferences and tastes. Obviously here, we're looking at the preferences and tastes of the consumer. Sometimes it happens where a lot of South Africans leave the shores of South Africa to greener pastures, or what they think is greener pastures, and they go settle in foreign countries. But once there, they realize, but I'm longing for some South African stuff which I don't get outside, like stony ginger beer, like knickknacks. And therefore, if you go to London, there's actually a South African shop that sells South African products there. So as people move around the globe, they long for their home products, and then those have to be imported to those countries. Right, difference in consumption patterns. Obviously, this is going to determine by the level of development a country finds itself in. So if you think of developing and developed countries, in developing countries, there'll be a bigger demand for basic goods, whereas in your developed countries, there will be a bigger demand for luxury products or luxury goods and services. Right, very quickly now again, the reasons. Sometimes you can be asked, list 2 reasons, or what, they give you a scenario, and you must recognize the reason from the scenario. So the demand reasons for international trade are size of the population, income levels, change in the wealth of the population, preferences and tastes, and difference in consumption patterns, right? So even if we just learn those headings, because these here, these 5 listed here, 5 reasons listed here, will also form the headings for your body of your essay. If your essay says, discuss the reasons for international trade, or discuss the demand reasons, then obviously you will already have 5 of your 26 marks by just writing down these headings, and then obviously discussing each of them. And please note, your discussion can either be you studying it directly from the notes or the textbook and just spitting it out, but I find if you understand the reason, you can write and write and write. So just to recap quickly, when we look at the size of the population, you're looking at the population growth. So you can write a whole story around population growth there. Income levels, right? So as people's income levels change and they have more disposable income, so that's what we're discussing under income levels. When we talk about the wealth of the population, the change in the wealth, here we're talking about people having access to credit, right? Not under income levels. In the wealth, here we're talking about access to credit. When it comes to the preferences and taste, it doesn't just have to be South Africans going outside. I've also seen in South Africa lots of shops now selling foreign products here, because we have so many foreigners who have come to settle in South Africa. So that's what that is all about there. People traveling around the globe, setting up homes outside of their normal homes, and therefore they now want their foods from back home as well. Right? And then the difference in consumption patterns, here you tell the story about the difference between the demand in a developed country versus the demand in a developing country. Okay. Then we look at the opposite of demand, as we all know. That is obviously supply. So now we're going to look at the supply reasons. And for me, this is the easiest one to remember, because when we go through those supply reasons, you will see a lot of it deals with your factors of production. So the first reason is your natural resources, right? So your natural resources, this goes without saying, this gives rise to, remember, we've got to discuss natural resources as a reason for international trade. And this is one of the biggest reasons countries have to trade with one another, because natural resources are not evenly spread across the Earth's surface. Some countries have tons of natural resources like South Africa, and others have absolutely nothing, so they have to import it from outside. We're just fortunate in South Africa that we have a variety of resources at our disposal. And South Africa has made full use of that with regards to their gold and diamond resources. Have given them the advantage there. So with each country having its own unique mix of resources, they have to then buy in from other countries for the resources they do not have and which they do need. The next one is the climatic conditions. Now, as you know, climate plays a role when you're thinking of agricultural products. And here we have that in certain areas, some areas are just good for the cultivation of a particular product. And I'm thinking here specifically Brazil and its coffee production, right? Not that Brazil is the only one that produces coffee. We get Kenyan coffee, we get coffee from all over the globe, but Brazil is the country that is known to produce, they've been the largest coffee producer all along. So when it comes to climatic conditions, here you're looking mainly at your agricultural products. Then your labor resources. Now, it is so that in some countries they have quality, quantity, and the cost of the labor differs, right? We're talking quantity, the amount of labor. We're talking quality, the skill of the laborers. And we're talking the cost of labor. In other words, what they have to pay in terms of wages and salaries also differ. So, and then it is so that some countries have a highly skilled labor with high productivity rates, and then you have others who obviously have a huge number of unskilled laborers. So when a country have a large amount of highly skilled people, they are able to produce goods that are much, much cheaper than anywhere else, right? So obviously, they will then become, like, for example, China has become sort of the dominant power with manufactured products, right? The quality might not be all that we would like it to be, but they are the ones that are dominating the manufacturing sector. And with this also, with some people having, or some countries having a highly skilled labor force, like, for example, I'm thinking here of the Swiss and their watchmaking. They become renowned for their watchmaking. And then technological resources. This is, like I said, some countries have access to technological resources, which also allows them to produce goods and services at a much lower cost. But here, once again, when it comes to technology, I think of a country like Japan, who a forerunner with technology. And then the second last one is specialization. So as a result of specializing in the production of certain goods, countries can now make use of what we call the economies of scale, right? And just today somebody asked me, what does that mean? Economies of scale is where you get maximum output with minimum input, meaning my inputs are much greater, my outputs are much greater than my inputs. So that means that you are able to produce goods at a comparatively cheaper unit cost than others can, Okay, so that is one of the reasons, supply reasons for international trade as well. And then the last one deals with capital, right? And here we're looking capital. Remember, there is money capital as well as capital goods. And it is so that your developed countries enjoy an advantage over the developing countries, right? Because some countries don't have access to the money resource, to the money capital, so they can't buy the capital goods, or they don't have access to the capital goods, they then can't make the goods that they need themselves, and therefore they are then forced to buy these from outside. So as I said, this is your essay question, and if the question says discuss the reasons for international trade without stipulating whether you must talk about demand or supply, then you can discuss a few demand reasons and a few supply reasons, right? But if it specifically says discuss the supply reasons, then you only have to write about supply. Or if it says discuss demand reasons, you only have to write about demand. So therefore, it is best that you know all of them, because you can also be asked, discuss the following supply reasons as an 8 marker. You could be asked to discuss the following supply reasons or the following demand reasons for international trade, and you don't know which ones they're going to ask. So don't think, okay, I'll learn 3 of these and 3 of these and I'll be fine for my essay. What if now in the test it says discuss preferences and taste as a demand reason? Then you wouldn't know what to do. Okay, so therefore, once again, as I said, understand each one and know what each one deals with. So if we look at natural resources now under supply reasons, there you're going to talk about it being unequally spread across the Earth's surface. Give examples of countries where they've made full use of their resources. Climatic conditions, you're looking at the weather patterns. You're looking at what crops are best grown where. Your labor resources, you're looking at the skill levels of your workers. Technological resources, the people with access to technology. And then specialization as a result of those highly skilled labor, of having access to technology. Some people can produce things much cheaper, so therefore they specialize, and here you have to make mention of the fact that they can take advantage of the economies of scale. And please explain to the marker what is meant by the term economies of scale, right? That means that you are able to produce the good at the lowest possible cost in comparison to other countries. And then the last point here is capital, and we refer to both capital, money capital, as well as capital goods. And this is obviously where your developed countries, once again, have an advantage over your developing countries. And that would be the entire essay on international trade. Right, we're moving on to the foreign exchange graphs. Right, so we will start with the explanation of supply and demand for different currencies, as well as the reasons for the shifts of the curves. Right, when the value of the currency of one country appreciates, the value of the other country depreciates. We see that happening all the time. As the American dollar gets stronger, the rand is getting weaker. So that we say the American dollar is the currency appreciates, right? And when it's getting weaker, the currency is depreciating. Now remember, I'm sure your teachers must have taught you the difference between appreciation and depreciation. Appreciation and depreciation happens when it is as a result of demand and supply that happens, right? Right. The exchange rate is the rate at which one country's currency can be exchanged for that of another country. Just a reminder of what the exchange rate is. So, for example, 15 rand for $1 US. So $1 is to 15 rand. So to buy one, okay, today, not in today's terms, today it's about 18 Rand to a dollar. Okay, now I'm going to just sketch a few scenarios and I need you to think about what will happen to the Rand. Right, number one, more Chinese traveling to South Africa. What is going to happen to the value of the Rand? Here you need to tell me, is it now going to increase or decrease? What will happen to the value of the Rand? Right? Will the Rand appreciate or depreciate? What do you think? And why do you say that? I don't need you to write this down. I just need you to think about it for a moment. And let's see how your thinking is. Right? The demand for rands is going to increase. So obviously when demand goes up, and there's an excess demand, that then means the Rand appreciates because now people are willing to pay more, because when demand is greater than supply, that causes a shortage on the market, and when there's a shortage, prices increase. Second scenario now, a severe recession in China. What effect will that severe recession in China have on the Rand? Now you need to think what happens during a recession and how is it going to affect us in South Africa when China has a recession. Obviously now there's going to be a decrease in the demand for Rand. Nobody's going to want to travel. They can't afford to travel during a recession. Nobody's going to be buying South African products. They can't afford that, right? So therefore, there's going to be a decrease in the demand for Rand. So now the Rand will again depreciate. Because with the demand decreasing, that's going to lead to an oversupply. And obviously with an oversupply, it will cause the price to drop. Right, increase in the price level in South Africa. When we talk about increase in price level in South Africa, you're obviously referring to inflation. You should know that by now, that increases in price, that is inflation. So what's going to happen to the value of the Rand when that sets in? Right? Once again, there's going to be less demand, so therefore your Rand once again will depreciate because demand has gone down. And when there's a higher interest rate in South Africa, then we will find that the Rand will appreciate. And some people will say, no, higher interest rates are bad. Yes, for us who have debt to pay, having higher interest rates makes us nervous. But if you are investing and you're earning more money, more people would want to invest so that they can earn that higher interest rate. Right, let's just quickly look at the demand and supply of foreign exchange. And here we're going, on this graph, we are looking at the exchange rate equilibrium. Okay, so remember when drawing a graph, you always start by drawing your two axes and you put in your point of origin, which is your 0. The next you label your axes, so here it's going to be Rand per dollar, and here we're going to have quantity of dollars, right? And then when we're doing equilibrium, equilibrium always exists where demand and supply are equal, so that point where the demand curve meets the supply curve, that will be your equilibrium point, which is represented by the letter E, right? And anything above the equilibrium, you can see it from the graph. Look at where supply is, look at where's demand, right? So above the equilibrium, there's excess supply. Below the equilibrium point, there's excess demand, because can you see where's demand and where's supply, right? Demand is much further away from the zero than supply, whereas up here you have the opposite, okay? The supply is much further from the zero than the demand. So that's how you can recognize your excess supply and your excess demand. So in this graph now, what do we find here? There's your demand curve, DD. There's your supply curve, SS, okay? And so the South Africans want to spend or buy American products or make investments in America, so they are wanting to buy the dollar, right? So which means they are demanding the dollars, right? And then SS is the supply of dollars, right? So that is the Americans who have to now supply. Okay, and why would they supply? So they would sometimes need the rand as well, so they would want to buy rand in order to pay for the stuff that they buy from us. So where the two meet, like we said, is our equilibrium. So there we have the rand. It will be 18 rand per dollar, and at 18 rand per dollar, there are $5 million being demanded. This is not factual. This is just made up so that we can just see what it looks like, right? So what we're saying, at 18 rand per dollar, $5 million are being demanded, right? Very similar to your normal demand and supply that you've been taught with microeconomics. Remember, this is macro we're busy dealing with. Right, so we take this a little further now. Okay, so here we've got the demand for the dollar. So, like I said, you first draw your axes, your point of origin, your price of dollars, your quantity. So if you look at this graph here, you would see there's been D, that's your original demand curve, and that curve has been displaced to the right to D1, which has also now caused your equilibrium point to move from E to E1. So you can be given a graph like this and questions asked on that, okay? But we need to look at what's happening here, right? What is taking place here? This is telling me a story, okay? So let's first look at the story by just analyzing the graph. So originally, it was 16 rand to the dollar, and at that point, the equilibrium was at $3 billion, right? And then there was an increase in the demand for the dollar, and therefore the price of the dollar changed from 16 rand to 18 rand a dollar, which also then shifted the equilibrium from E to E1. So at 18 rand a dollar, it now settled on 5 million. Now people say, but according to the law of demand, when the price increases, the demand's supposed to drop. But remember, the price change as a result of the increase in demand, right? There was first a change in the demand, and it is that change in demand that has caused the price to go up. So you must be very careful, okay? So why would there be a demand for dollars? Various reasons. There could be South Africans deciding we are taking a holiday overseas, right? Or more South Africans saying, oh, I want to invest in some of the American companies now. Or people are just buying goods from outside, from America, right? So therefore, we see the shift from D to D1. But the important thing to note here, this is dealing with increase in imports. So whether you're investing, whether you're traveling to America, whether you're buying American products, this is an increase in imports. So the demand has shifted and therefore more money flowing out of the country now. Okay, so now we see the price of the dollar has gone from 16 Rand to 18 Rand. So what does that mean in terms of the Rand now? The value of the strength of the Rand now. So in the past, we were paying 16 Rand a dollar, but because of this increase in demand, we are now paying 18 Rand for the same dollar. So that means the value of the currency has weakened, right? So we say the value of the Rand has weakened. Once again, something that confuses the learner. But it's going from 16 to 18. Yes, but 16 to 18 in terms of what? You are spending more to buy a dollar than you have before. So therefore now the value of the Rand has weakened. Because that increase, it's the dollar price that's increasing. Right. So very quickly, imports increases, buy more machines from overseas, South African citizens make more investments overseas, etc. More money flow out of the country, so there's a demand for dollars or foreign exchange increases. The demand curve D shifts right to DD1. The new equilibrium exchange rate is from E to E1, okay, where the equilibrium price is 18 Rand, and then the amount of dollars or foreign exchange purchase increased from 3 million to 5 million, and the value of the Rand weakened. In other words, the value of the Rand depreciated against the dollar, and the opposite of that is obviously the value of the dollar strengthened, so the value of the dollar appreciated against the Rand, not against the dollar. That's an error there, sorry. Okay, so I hope you understand this graph now, right? So this one deals with an increase in imports. So what is going to now happen if there's a decrease in imports? So obviously if there's a decrease, you're going to have the opposite. Then that demand curve is going to shift to the left. And obviously with a decrease in the demand for the dollar, that's going to cause the Rand now again to strengthen. So if this graph here shows you an increase in imports, so when there's a decrease, it's going to be opposite to what you're looking at here. And that discussion is also just going to be opposite. Okay. Right. Let's look at the supply of the dollar now, right? Let's look at from a supply perspective. We've looked at it from a demand perspective. Now let's look at a supply perspective. Once again, let's first just see what is this graph telling me. There's my demand curve. Original supply is E, and my original cost was 20 Rand to the dollar and 2 million being demanded and supplied. Then there is a shift from the 20 to 18 Rand. The supply has moved out. The demand didn't go anywhere. The supply shifted to S1, and that caused now the price of the dollar to decrease from 20 to 18. Because remember what has happened now? What did we say? You can see here, with that supply shifting, right? What has happened now with the demand? You see there's now a bigger demand, right? So what is happening here? Why is the supply shifting? Because now, remember with the demand, the graph before this, we looked at the imports. Now we are looking at the exports. So what's happened here is the exports has increased, okay? So South Africa received more loans from overseas, or there are more American tourists visiting South Africa. So there's more money coming into the country. So the supply curve moves from S to S1, and then the new equilibrium exchange was at 18, okay? And the equilibrium quantity now increased from 2 to 5 million. So here we see now, instead of paying 20 Rand a dollar, we are now paying 18 Rand a dollar. So yes, the price has come down, but now the Rand is strengthening, right? There's a strengthening of the Rand, and now we say the value of the Rand has appreciated against the dollar, whereas the opposite is the value of the dollar weakened, meaning the value of the dollar depreciated against the Rand. Grade 12s, please make sure you use the correct economic terminology when discussing these, right? Talk about the value of the Rand strengthening and also explain what that means. It means the Rand has appreciated against the dollar. Right, so obviously here, there's an increase in exports, and once again, the same like with imports. If there's a decrease in exports, then it will go the other way again. So, just to reiterate, when you're dealing with the demand of the dollar, that's when we're dealing with imports. When dealing with exports from South Africa to America, then you're dealing with the supply of the dollar. Right, that was now quite a mouthful said, and now there's a little activity for you to quickly look at, and I'm going to give you 2 minutes to just quickly look at this. Right, first study the graph, and this graph deals with the supply of the dollar, so that tells me we're looking at imports or exports here now. So obviously this deals now with exports. And the fact that the supply is going that way, where it's displaced to the left, where there's a decrease in the supply, that means my exports are decreasing, right? So I first study the graph to see, do I understand what this graph is saying to me? Okay, so it's dealing with the supply of dollar, right? Then it is exports. Supply is being shifted to the left, meaning a decrease in the supply of dollar, therefore decrease in exports. Okay, so now I move on to the questions to see what it is asking of me. And the first question asks, what is the equilibrium quantity at $1 to 8 Rand? What is the result of a decrease in the supply of the dollar on the value of the Rand? And briefly describe the term appreciation of a currency. And what will the impact be of an overvalued currency on the balance of payments? And then why do some countries prefer a fixed exchange rate system? Sure, I think 2 minutes is a bit little for all of these questions, actually. Okay, let's look at those answers very quickly now. The equilibrium quantity, where it is 8 Rand, so we go to where it says 8 Rand, and we follow the dotted line to E, and then we go down to the quantity line, and we see there, the answer is 12. But we can't just say 12 because it says quantity, and in brackets here it says million, so my final answer will be 12 million. The next question, what is the result of a decrease in the supply of the dollar? So what has happened? We see the supply move from S to S1. So it used to cost me 8 Rand a dollar. Now it's costing me 9 Rand a dollar. So what has happened here? The Rand has depreciated because it's costing me more Rands per dollar, right? And then number 3, it speaks about the appreciation of a currency. So when a currency, in this case now, the dollar has appreciated against the Rand, so that means the value of a currency strengthening against another currency. Right? And what will be, let's just quickly look at those answers. Right. The next one, what will be the impact of undervalued currency. Now here's another term, because we were using appreciation and depreciation. Now we're talking about undervalued, right? So impact of undervalued currency on the balance of payments. So an undervalued exchange rate means that the country's exports will be cheaper and the imports relatively more expensive, right? Why do some countries prefer a fixed exchange? Remember, I said to you, most people don't really follow this anymore, but it does have its positives. So fixed exchange rates provide greater certainty for exporters and importers, and also help the government maintain low inflation, as well as it supports competitiveness of its goods as they are sold abroad. Remember, you're not just competing within your own country. When you're dealing with international trade, you are up against the rest of the world. Right. Here is the one question that I warned you about earlier on. So the question says, briefly discuss the following demand reasons for international trade, and you've got to talk about income levels. And remember, I said to you, when you talk about income levels, you just talk about how the change in income causes a change in the demand for goods and services. Now, that's only going to give you 2 marks. It's got to be, because there's another one, which is for a total of 8 marks. So you've got to discuss one for 4 marks and then the other one for 4 marks. Okay, so obviously, higher income creates more needs and wants, and therefore a greater demand for a greater variety of goods. So if the country doesn't have everything locally, it has to then be bought from outside the country. So those 2 points on their own will then give you your maximum of 4 marks. And then the other reason that you need to discuss is preferences and tastes. Okay? So obviously, once again, only for 4 marks. Obviously, the answer that I'm giving you is what we call a memo answer. It's got to give you all the possible answers, but we only need 2 points from here. Okay. So not all the goods wanted or produced in a country. Consumer preference and taste play a decisive role in demand of goods from foreign countries. If consumers in China have a preference for tea and consumers in America have a preference for coffee, the relative prices of tea and coffee will differ between these countries, right? This is influenced by international migration in terms of religion and lifestyles. Right, this is a full 8 mark and can even be a 10 mark question. How does an improvement in terms of trade influence the balance on the current account? Right? So now you've got to think back, what is terms of trade? So tell the marker what it is. So there you say the terms of trade indicates the ratio of the index of export prices to import prices. Okay? So an increase in export prices or a decrease in import prices will improve the terms of trade. So now you've explained what the terms of trade is all about. So this will result in an improvement of exports compared to imports, affecting the current account positively, right? This can lead to a reduction in the deficit or an increase in the surplus on the current account, which will reduce the pressure on the reserves. It might, however, over the long term, result in decrease in sales volumes depending on the price elasticity of demand in the foreign countries, with less income being generated by exports, so therefore leading to welfare loss. Right? So this is what we call your out-of-the-box question. You're not going to find these things as is in a note. You've got to now gather all the things you've learned about the different things and now put it together in an answer here. Okay, so first of all, we explain what the terms of trade is all about, and now we can say how it affects the current account and what can also happen. So sometimes it can be good, but there is also, it doesn't ask you for only positives or the negatives, right? So if they don't state positive or negative, you can argue from both sides of the coin, from both the positive as well as the negative. Okay. Right, just to recap what we've done for today, we've looked at foreign exchange markets, and we specifically concentrated on the reasons for international trade, bearing in mind we spoke about demand reasons as well as the supply reasons, right? And under the demand reasons we had 5 points, and under the supply reasons we had 6 points. Okay, so very quickly again, for the demand reasons, we said was the size of the population, income levels, change in wealth of the population, preference and taste, and the difference in consumption patterns. Whereas for the supply side reasons, we spoke about natural resources, climatic conditions, technological resources, capital, labor resources, as well as technological resources. I don't know if I mentioned that one already. But as I said, for supply, just remember your factors of production and it will be easier to remember. We quickly touched on the balance of payments, and what you need to remember here obviously is that your balance of payments consists of 3 accounts, which is your current account, your capital transfer, and your financial account together makes up your balance of payments. And then we looked at the foreign exchange graphs, and we looked at how demand and supply plays a role in setting the value of the currency. And when we look at your rand going from 8 rand a dollar to 9 rand a dollar, although it looks like the prices increase, the actual effect on the value of the rand is a decrease, right? It's a depreciation of the rand. And then the other way around. We've also looked at the shift in the curves. So when we see demand shifting, then we know we're dealing with imports. When we see a shift in supply of the foreign currency, then we know we are dealing with exports. And then obviously in the end, our final activity sort of just wrapped up all the things that we've discussed. But very important to your take home for today are those terminology that we did at the beginning, your international trade essay, and then those questions at the end where we try to culminate everything. Thank you so much for attending today, Matrix, and good luck with your exam later this month.